Spirit Airlines, once recognized as a pioneer in the ultra-low-cost carrier market, transformed air travel by providing no-frills, budget-friendly flights across the United States. Founded in 1983, the airline's aggressive pricing strategy and rapid expansion attracted cost-conscious travelers and disrupted traditional airline models. However, behind the appeal of affordable fares and swift growth lay several challenges that ultimately led to its financial decline. In November 2024, Spirit Airlines filed for Chapter 11 bankruptcy protection, marking a significant moment in aviation history. This video explores the factors that contributed to Spirit's rise and the multifaceted issues that led to its downfall. The airline began operations in 1964 as a trucking company under a different name. It later transitioned to a tour operator and started offering flights in 1990. 2 years later, it rebranded as Spirit Airlines. The company's modern identity can be traced back to 2006, when Indigo Partners, a private equity fund, acquired a majority stake in the airline. Under Indigo's ownership and the leadership of Ben Baldanza, who served as Spirit's CEO for a decade and passed away this month, the airline focused on reducing costs and providing low-priced, no-frills tickets. Although this business model often made Spirit the target of late-night jokes, it also significantly reshaped the airline industry. Travelers were drawn to Spirit for its low fares, frequently overlooking concerns about the quality of its service. The airline consistently reported profits, prompting other companies to attempt to replicate its approach. The airline's strategy proved successful, leading to rapid expansion across domestic and international routes. By 2020, Spirit had become the largest ultra-low-cost carrier in the United States, known for its bright yellow planes and cheeky marketing campaigns. Its growth trajectory appeared unstoppable, with plans to further increase its fleet and route network. Despite its initial success, Spirit Airlines encountered numerous challenges that eroded its financial stability and operational efficiency. The COVID pandemic, which began in 2020, severely impacted the airline industry, and Spirit was no exception. The airline reported losses exceeding $2.5 billion since the onset of the pandemic, with a particularly devastating $1.2 billion loss in 2024 alone. These losses were compounded by looming debt payments, totaling over $1 billion due in 2025 and 2026, creating a precarious financial situation. To stabilize its finances and expand its market presence, Spirit pursued a $3.8 billion merger with JetBlue Airways. The merger would have provided the company with a vital opportunity, and losing that chance resulted in a significant financial setback. Meanwhile, the company has faced additional compound challenges, creating a hostile business environment. However, the U.S. Department of Justice blocked the deal in January 2024, citing antitrust concerns. The collapse of this merger not only thwarted Spirit's expansion plans, but also eroded investor confidence, further exacerbating its financial woes. Spirit's reliance on the Airbus aircraft family became a liability when widespread issues with Pratt & Whitney engines grounded several planes. Issues with its engine manufacturers have led to grounded planes and higher costs. Although there is still a high availability of seats, demand has fallen as travelers seek to save money during the current cost of living crisis or pay more for enhanced comfort options offered by legacy carriers. This significantly reduced the airline's capacity and revenue-generating potential. Additionally, Spirit's rapid expansion strategy outpaced market demand, resulting in underperforming routes and operational inefficiencies. The ultra-low-cost carrier market became increasingly competitive, with major airlines introducing basic economy fares to attract price-sensitive travelers. This strategic shift by larger carriers diminished Spirit's competitive advantage, as passengers now had more options for affordable travel without compromising service quality. Additionally, an oversupply of flights in leisure markets led to fare reductions, squeezing profit margins for budget airlines like Spirit. While Spirit maintained a reputation for low fares, its operational costs began to rise, particularly in labor expenses. The airline faced challenges in retaining staff, leading to increased wages and benefits to remain competitive in the labor market. These escalating costs and declining revenues strained the airline's financial resources and contributed to its unsustainable fiscal trajectory. Spirit's management faced criticism for strategic decisions that failed to adapt to the evolving aviation landscape. Without adequate demand forecasting, the airline's aggressive expansion into competitive markets resulted in underperforming routes and financial losses. Furthermore, the reliance on ancillary fees as a primary revenue source became less effective as consumers grew wary of hidden costs, diminishing the appeal of Spirit's low base fares. Recognizing its unsustainable financial situation, Spirit Airlines filed for Chapter 11 bankruptcy protection in November 2024. The filing aimed to restructure the airline's debt and operations, allowing it to continue functioning while addressing its financial obligations. As part of the reorganization plan, Spirit sought to convert debt into equity and secure additional financing to stabilize its operations. Spirit Airlines has officially emerged from bankruptcy after completing a financial restructuring designed to ensure its long-term stability. Known for its bright yellow planes and budget-friendly fares, the low-cost carrier has significantly reduced its debt and is now embarking on a new path that could transform its reputation. In early 2025, Spirit emerged from bankruptcy after a 4-month restructuring process. The airline equitized $795 million in debt and secured a $350 million investment to support its plans. CEO Ted Christie continued to lead Spirit alongside a newly reconstituted board of directors, with the company aiming to rebrand as a premium airline, moving away from its no-frills reputation. As part of the plan, Spirit Airlines has canceled its previous stock and will issue new shares that will initially trade on the over-the-counter market. The airline intends to relist on a significant stock exchange in the future. Additionally, Spirit is planning a strategic rebranding effort to move away from its no-frills image and position itself as a premium low-cost carrier. While the specifics of this transformation are still unclear, the company has indicated that it aims to enhance the travel experience for passengers while keeping fares affordable. Spirit Airlines carved a niche in the aviation industry by adopting an ultra-low-cost carrier model. This model emphasized minimal base fares while charging for additional services such as seat selection, baggage, and in-flight refreshments. This strategy allowed the airline to offer some of the lowest ticket prices in the market, attracting travelers willing to forgo traditional amenities for cost savings. The most crucial task for any business that has endured a crisis like COVID is to assess how much the situation has changed the market in the medium term. While things may seem back to normal, we must consider how different this normal will be. From this assessment, the primary challenge is to evaluate corporate strategy and critically implement the necessary changes. This is one of the toughest tasks in governance, yet it is crucial for organizational resilience and what distinguishes the best companies. The company placed significant trust in the possibility of a merger, whether that was justified or not. This approach would be acceptable if the merger had succeeded. However, since it did not, it raises concerns about whether the airline received appropriate legal advice regarding such a risky strategy or if it acted out of sheer optimism without proper guidance. Spirit Airlines' bankruptcy story illustrates a complex interplay of market dynamics, strategic decisions, and operational challenges. While its low-cost model democratized air travel for many, the airline's inability to adapt to changing industry conditions ultimately led to its financial downfall. As Spirit endeavors to rebuild and rebrand, its journey serves as a poignant reminder of the delicate balance between cost leadership and operational resilience in the competitive world of aviation. Like, comment, and subscribe for more videos.